Hey, great pre-show tunes, by the way, Joe. Thank you very, very much. Well, listen, hello, and welcome back to the Coldwell Banker Wealth Builder Expo series. I want to also formally welcome our friends and Wealth Builder partners at Guaranteed Rate Affinity Mortgage. And to everyone, however you got here, wherever you are, we're glad that you're here. Thank you for joining us today. And if we haven't had the opportunity of meeting yet, hi, I'm Chris McGatt, and today I come to you from sunny and not too snowy yet Denver, Colorado. Casa de los Broncos, as we say. Listen, I'm confident you're going to really enjoy the program today, and you're going to learn a lot in the process. As I've said before, if you're in search of a proven way to grow and protect your personal wealth, well, you have come to the right place. Listen, during this year of uncertainty, I think many of our competitors across the country are focusing solely on getting the next deal closed. But make no mistake, at Coldwell Banker, we are committed to going far beyond that. In fact, I believe that by working together, we can support you in building real wealth, something you can enjoy and leverage for years to come, something we call living an exceptional life. And rest assured, we deliver on that promise of helping you live an exceptional life by staying laser focused on our core four: production power, coaching and confidence, an amazing culture of awesomeness, and well, why we're all here today, Wealth Builder. But just fair warning, if you're thinking that building wealth is a spectator sport, I'm thinking you might be in for a bit of a surprise. Wow, that graphic definitely says it all. Thank you, Kelly. Here's what I do know. To get the most out of today's session, and in fact, our entire series, you have to plan to roll up your sleeves, engage in the content, and do the work. Listen, building wealth isn't hard, but it is serious business. And to be successful, it requires focus, commitment, and yes, self-discipline. Now, speaking of self-discipline, if you haven't done it yet, take the time right now, right this minute, to open a SEP IRA retirement account. Now, remember, we make it super easy for you by helping you create those automatic closing deductions. So the money goes right to the SEP account right from the closing table. Now, if you want to find out more about what a SEP account is, or how to open one, or even how to increase the amount you're setting aside, there's a link you can click right now at the wealthbuilderexpo.com site, or check out the link and the chat session on the right-hand side of your screen. Now, both of these will direct you to a site to schedule an actual confidential conversation with an SEP, a SEP retirement specialist. Trust me, do it right now before you get sidetracked with life, because that does happen. You know, one of the things I like most about our Wealth Builder series is that we've created this safe place to explore our personal finances and goals. It's a place to have open and honest conversations. You know, isn't it interesting how most Americans buy things they don't need with money they don't have to impress people they don't even like? Oh, it is crazy. And Wealth Builder is here to break that vicious cycle. As you explore building wealth, I encourage you to stay out of judgment and in curiosity. Imagine what could be possible if you had this support and you exercised self-discipline. The question really we have to ask ourselves is, how badly do we want to change the trajectory of our financial future? We've also discovered that our journey to financial success rarely happens in a vacuum. And that's why we encourage you to invite your support team to each Wealth Builder Expo. That could be your spouse, partner, or advisors. It's really a team effort. So be sure to get your team on the field with you. You'll be more successful if you're aligned in your vision with the people that matter the most to you. And yes, getting answers to your questions is actually at the very heart of why we're here today together. So don't miss this important opportunity. It's so easy. If you're joining us on Teams today, as you look at your screen, you should see a Q&A button in the upper right-hand corner. And if you're catching us today on Facebook Live, welcome. Simply message your question to us or put your question into the comments. And once we reach that Q&A section of the program, our producer, Amy Crawford, will tee up all of your questions. Okay, let's get on with today's topic. It may seem obvious, but listen. Every dollar you can save in state and federal income taxes and fees means an extra dollar that you can invest in your future without even needing to earn additional income. And it's that very premise that makes today's topic so incredibly relevant. The idea of tax strategies for the independent contractor may not sound sexy or glamorous, but It's exactly how millions of Americans build wealth every single day. Now, don't worry about writing down every tip or strategy that you hear. We're going to be recording today's session for you to review. In fact, you can always check out wealthbuilderexpo.com for recordings for this session and any session before. And I'm also going to remind you that you're going to get a lot of content today. And unless you live in the world of tax strategies every single day, my guess is some of it may go over your head. It certainly goes over my head. That's why we're recording it. This is a step in a process to give you the information that you need. Now, rest assured, we have assembled a star-studded cast today. They are what I would affectionately refer to as the Dean Martin, the Frank Sinatra, and the Sammy Davis Jr. of tax strategies. They hail from the great city of Chicago, and they represent the Manning Silverman Company. For over 30 years, they've helped people just like us save money on taxes. So please help me welcome Adrian Scartu, Joel Manning, and Wayne Silverman to the Coldwell Banker Wealth Builder Expo stage. Gentlemen, thank you so much for joining us today. The floor is yours.
Chris, thank you so much. It's such a pleasure to be back, and thank you for inviting us again to another year of Wealth Builder. This year, I brought a few friends with me, Joel Manning and Wayne Silverman, founding partners of Manning Silverman Company. Now, we're all very happy and excited to be here today, talking about something like, honestly, we love talking about, taxes. Now, we know, and we agree, it's not something everybody likes talking about. But what we all do like talking about is how do we keep more of our money in our pockets? And that's something that translates from, like you mentioned, really good tax strategy. I like to start off with a story usually when I meet with new clients or at some of these events of my family. Now, not only do I like talking about them because, well, they're my family, but I think that the story is going to be very fitting. My father came to the United States in the late 80s and he wanted to be an engineer. He came here from Eastern Europe. However, most of the jobs were in construction. So what did he do? He started working in construction. And then he followed a path that many of us here followed, the path of entrepreneurship. He started a company. A few years later, hired a few employees. Not long after that, started investing in real estate, followed the American dream of entrepreneurship, something that everyone here as an independent contractor is following. Now, why else am I talking about my family? Well, my family's been a client of Manning Silverman Company for maybe 25 years. I think Joel's actually known my dad for 25 or more years. So not only are the tax strategies we're talking about, I think they're theoretically good, but I could tell you firsthand they're very valuable. I could tell you firsthand how much they've helped my family directly. Now, before I go on, like Chris mentioned, we're going to be talking about a lot of information. Some of it a little more detailed, some of it a little bit easier to understand. But please stay with us. This event will be recorded and you'll be able to play it back. Watch it again, 2 times. Maybe watch it with your accountant. So please do stay with us. With that in mind, I'd like you to think. I'd like to pose a question to you. As an independent contractor, what is your single largest expense? Now, you might think marketing. Maybe you're paying some other independent contractors as well who work with you. Maybe travel. What about taxes? Would you agree with me that probably the taxes you pay are the single largest expense that you pay out of your pocket? Why don't we always think about that off the bat? Well, because we don't like to think about taxes, am I right? We think about it once a year when we go in, we get our taxes done, we send a check to the IRS, to the state, and then we like to try to not think about it for another 12 months. But what if our largest expense, what if we could bring it down? What if through the tax strategies we'll be talking today, we could bring that down by, let's say, $10,000 per year? I'm pretty confident that we could do so. Now, I did a little exercise and I took $10,000, saved yearly, invested every year for 10 years at a rate of return of about 10%. Now, would you believe that after 10 years, you'd have an additional $200,000? That's right. Saving about $10,000 and investing that yearly for 10 years could land us an additional $200,000 in our bank accounts. By working smarter, being proactive, taking advantage of the tax code, I'm very confident that we could do this. So, how will we do this? Well, there's a few things I like to talk about. We'd like to talk about. Number one, entity selection. Should we select an entity? Should we have an LLC, an S corporation? Could be confusing, but we'll talk about that. A few commonly overlooked tax strategies. Family. Should we hire our family members? Retirement plans. We talked about that earlier. There's a mention of a SEP IRA or funding retirement plans. That is such a good thing to do. We'll talk about that a little more. Travel. Can you really take advantage of travel, or can we think about travel a little bit differently? Section 280A. This is one that I love talking about, that I know that both myself and Joel have actually taught other CPAs about this. And in fact, Inc. magazine named it the #1 most overlooked business strategy for business owners in the United States. Something that I want everyone here to leave knowing about. Again, please follow along, and definitely this will be recorded afterwards. And finally, run it like a business. If we have a business, what are some good practices that we need to keep? So let's dive in. Entity selection. We're all independent contractors. Filing our taxes on our 1040 and our Schedule C. Should we incorporate? Should we form an LLC? Should we form an S corporation? I will say, hands down, an LLC provides great liability protection. However, it does not provide any tax savings. That might sound a little odd because oftentimes I hear a lot of people tell me, even family members, I need to form an LLC to save in taxes. No, the LLC has great liability protection, but not really the tax savings that we're looking for. The tax savings really come from an S corporation. Before moving on and talking about how we could have those tax savings, I will say that an LLC and S corporation do require some additional administrative fees, some additional administrative documentation to be kept. But if I were to tell you these extra fees are maybe a few $100s a year, maybe up to $1,500, but we could have substantial tax savings, I would take that. So, how does the S corporation help us? Well, let's take an individual making $100,000 of net income. So this is net after taking all expenses. When you're a sole proprietor, you pay something, if you've paid attention to your tax return, called self-employment tax. It's really the Medicare and Social Security equivalent. That's roughly 15.3%. Now, if you were an employee on a W-2, your employer would pay half of this for you. But since you're an independent contractor, there's no one else paying this for you. So it's roughly 15.3%. In our example here, that's $15,300. Now, when you set up an S corporation, you set up the separate entity like I mentioned. So you are now acting as both employer and employee. On the employee, the IRS requires reasonable compensation, and you have to give yourself a wage or a W-2. In our situation here, we have the same individual earning between wages and distribution, $100,000. The distribution, that is just the amount of money you're able to take out of the corporation as the owner. It's not a dividend, but it works kind of like a dividend. So let's stay with me here. So you're still earning $100,000. You're giving yourself a reasonable wage of $50,000. And on that wage, again, you're paying that FICA tax, Social Security and Medicare, of 15.3% roughly. But if you notice on the distribution, there's a zero here in the box. That distribution, there's no self-employment equivalent required. So just by setting up an S corporation, we're able to save in the self-employment tax, 15.3% on the distribution we take out. So in this example here, we're able to save nearly $8,000 by doing nothing more than incorporating into an S corporation. Yes, you have to file an S corporation tax return. Yes, you have to do quarterly payroll tax filings because the IRS requires it. But if all of that costs a few extra $100 per year, or maybe $1,200 or $1,500, whatever that may be, if you're saving nearly $8,000, I think that's a good deal. With that said, Joel, is there anything you'd like to add to S corporation and incorporating?
No, I think it's just a very important thing for everybody to start to look at doing. Adrian uses the number of 100,000 with 50,000 being wages and 50,000 being distributions. So that 15.3%, you're saving that 15.3% on the distribution. Think of some of you who make more, some of you who make less. That amount of money we're talking about saving is 15.3% of everything we're not calling wages. So that tax savings of $76.50 in Adrian's example could be significantly higher, and something we strongly encourage. And as you start to see some of the other things that we're going to be talking about today, you'll start to really see a large amount of savings.
Yeah, thank you. It's very important to note that definitely the more income you're earning, the more tax savings potential is there. Now, as we're moving on to the next topic, family, should you hire your family members or not? Let's take a moment to get in the chat box, send whatever questions we all might have while they're, still on the tip of our brain. Family. How true is it that oftentimes being an independent contractor, being a sole proprietor or small business owner, our family members end up helping us, whether it's running to the store and buying something or whether it's helping with an open house? Should you formalize that business relationship? Should you add your family members as employees of your business or as board members? Now, if your spouse or your children, if they are your employees, now each time they're running to the store, you could count those miles as business miles. If you have business meetings with them over dinner once a month, and you're talking about business and you're formulating a plan for your business, you're preparing for the month or talking about the month that passed, this becomes a business meal. College planning. This is something not often talked about. How can you use hiring your children for college planning? Now, paying college directly is not tax deductible for your business. But what if you hire your child who is ready to go to college and you pay your child directly and then your child, son or daughter, ends up paying their college? Why would you do that? Because presumably we're at a higher tax bracket than our children. So by doing this, we're able to pay our children and shift that income from a higher tax bracket to a lower tax bracket. So we're shifting that income over, and now our children are able to go on and pay their college. So paying the college is still not tax deductible, but what is deductible to the business is paying your children there. And even if you, end up paying your children a little bit more than you would to help cover their taxes a little bit, you're still in effect shifting income from a much higher tax bracket to a lower one. Some other advantages are children begin their wealth building journey earlier. Let's think about something else. What if our children are in high school and we start paying them there and tell them to start funding a Roth IRA or traditional IRA? Why would you do that? I want to talk about two of my clients. Let's call them Jim and Bill. What Jim did is he didn't plan ahead and he ended up just paying for his daughter's college. Bill thought a little bit differently. He said, in high school, I'm going to hire my daughter. I'm going to start paying her and then tell her that she will need to pay her own college. On top of that, at 15 years old, when she started working for him, they set up their retirement plan and she fully funded that. So again, I did a little bit of math and funding an IRA fully from 15 versus 25 years old. By doing that, what happened is at retirement age, the child who started funding at 15 years old was able to have nearly $1 million more in her retirement fund. Now let's think about that. Not only are we able to shift income from a higher tax bracket to a lower tax bracket, have our children pay their college, but we are able to teach our children the importance of saving money, helping them put money away in a retirement plan, helping them with their wealth building journey as well. With that in mind, the other thing that ties right into this, so we'll go to slide right in, is retirement plans. Once our family members are employees, we're able to set up retirement plans for them as well, either a SEP IRA or a simple plan, and we're able to contribute both as an employee and an employer. Now, I know there have been other great Wealth Builder events talking more about retirement plans, so we just wanted to barely scratch at the surface of this. The importance of retirement plans and hiring our family members. By doing this, we're able to, like I said, hire our family members and set them up with retirement plans as well. Before moving on, Joel, what's been your experience with clients and others hiring their family members?
So first we got to begin with, if you choose to hire your children, the first $12,000 that your business would be paying your children are federally non-taxable. So take a family who has 4 kids. We can now pay those 4 kids, as long as they have a business purpose and are doing work in our business, we can pay them $12,000 each times 4, 48,000, and that 48,000 we get the tax deduction for, but they pay no tax on that. So it's a real nice way to move $48,000 from from the government collecting money on it and keeping it wealth-wise in our family. I get a lot of clients who say to me, I don't really want to give my kids anything. I said, well, that's okay. You could still pay them the $12,000 and have them pay you back for pretty much everything: education, pay you back for medical, pay you back for clothing, pay you back for food. I have them pay you back for everything but rent, because I don't want to have you file that tax return. But in addition to that, let's talk about the kids that are going to college. If the kids are working for you and you're paying them, say, 5, 10, 20, 30, 50,000, whatever their college is, more of us, as we look at our husband and wife when our kids go to college, if we make between us 150,000 or more, there's really no real deductions for us to get from the government. But if our child is now making that $30,000 or $40,000, it's bringing our income down, and maybe we get under that 150,000 so that our child can get more money. But in addition, if our child is literally just making that 30 or 40,000, they may get those tax credits from colleges that you would not qualify for. So what I want to do is just kind of mention a couple of those things, and I really want to say, if you have any questions, please email them to us, put them on the chat line today, call us. As a favor and appreciation for Coldwell letting us stay here, there's no charge for you to call us and let us answer any of your questions. Adrian?
Yeah, thank you so much, Joel. Now, as we're moving on, the next thing we'll want to talk about is travel. So we know that local travel is tax deductible, right? Going over to an open house, maybe running over to the store. But what about if we're traveling out of state? What if while we're traveling, we do some, go to some personal activities as well, maybe go to a theme park? What's going on with that? Is that a business trip? Is that a personal trip? What's happening? Well, the IRS states that for a trip out of state to be a business trip, 50% of the time must be spent on business-related activities. The IRS calls a workday 8 hours. So if we're spending at least 4 hours a day on business, or at least half of our days working, that now becomes a business trip. All right, great. But let's think about something we like to call lifestyle travel. And this is something that we need to be a little bit more proactive on. Not we took a trip, we're looking back and we're saying, oh, maybe this was a business trip. We definitely need to be proactive and forward thinking and take some action in our tax planning here. Lifestyle travel is travel that we may do regardless. Let's say we have young children who want to go to Disney World. And let's say we're planning on going down to Florida for a weekend. So now we think, okay, this is all going to be a recreational trip. But when you go down there, you think, there's actually maybe some agents I want to go and network with. Well, this is where the proactive planning comes into play. If you're able to, let's say you're Saturday and Sunday at Disney World, on Friday and on Monday, you spend both days working, then that entire trip becomes a business trip for travel purposes. And here's why. Wouldn't you agree that it's much more effective to fly down there on a Friday, do some work on Friday, then not come back on Friday night or Saturday just to go back for the recreational trip and then come back on Monday? So the IRS agrees. If you have travel or if you have business related activities on a Friday and on a Monday, so this would probably be the full days, then your hotel and your travel airfare for the entire trip is a business trip. What if you go out of town and you say, I don't have a full day of work to do on a Friday and on a Monday, but I'm going to be somewhere on a Tuesday and on a Wednesday. Well, just make sure that on that Tuesday and Wednesday, at least 4 hours per day, you're doing some type of business related activity wherever you're traveling to. Now, again, you've turned half of that trip or a little more than half of that trip into a business trip. So let's think, what type of travel are we doing already, this lifestyle travel, that we could plan ahead and say, on this trip, I'm going to do some business as well, have some work related activities and turn this into a business trip and a legitimate business trip. Again, we need to have documentation of what we're doing, who we're meeting with. So this is definitely not me saying, go take your trip and count it as a business trip, because if the question came up, we need documentation. But if done right, if being proactive and planned well, we believe that a lot of trips that we're doing, and if you're able to have some work-related activities as well, you could definitely turn these trips into business trips. Joel, you want to talk about that and also about the benefits of having, family travel with you?
Yeah, so what we found is so many clients are so excited when it comes down to travel. We all like to travel. We all like to go out to eat. And what we found was by thinking a little bit smarter, when you incorporate maybe think about, can my spouse, my significant other, my kids, can they be part of that entity? So when we travel, not just regular business travel, but when we have a corporate board meeting in Disney World or Las Vegas or Nashville, how can we make all of these things deductible? I love to share that people who have a cell phone, it's my favorite way of documenting things. You're out at a restaurant, you have a little agenda in front of you. Take a picture of the agenda of the people that are there at the meeting. You're having a business meeting, always have some sort of agenda. You're a realtor heading out to Florida and you just stop in some realtor offices, have a meeting, maybe take a picture of the business cards of the people you're meeting. Things that don't take an awful lot of time, but really, really, really generate a lot of money. Too many people in this world worry about how much money we make. Adrian and I and Wayne, our number one thing is to figure out how can we help you keep as much of your money as possible.
Thank you so much. Now, again, as we're moving on to the next topic of depreciation, definitely go in the chat box, start sending over your questions for the Q&A portion. Now, depreciation. I'll just give a very, very quick summary because depreciation is something very detailed and that probably not many of us care about the minuscule details. Pretty much when we buy a bigger asset, we can't just write it off. We can't just buy a huge piece of equipment and just expense that. It needs to be depreciated or written off over a certain amount of years. But something interesting happened at the last 2 years back at the last tax overhaul. And this is, and I don't even know how this got through the tax code, but it did. If you purchase a business vehicle that's 6,000 pounds or more through special depreciation allowance, bonus depreciation, Section 179 for those who are familiar with these terms, you're able to write off 100% of that vehicle. Now let's think about that. Maybe just the type of vehicle we purchase could have a big impact on us. Instead of buying a smaller Cadillac, buying the Escalade. Instead of buying a smaller Audi, buying the Audi Q7. So what does that mean? Well, let me give an example. I actually had a client who purchased a Cadillac Escalade, someone who drives around the country a lot, and he likes to drive and not fly. Bought the Cadillac Escalade and realized that he was able to, through special depreciation, write off that year $100,000 about there, what he paid for the car because he's a very high income individual. After realizing that, a month later, he called and said, well, my wife, who again works for me, like we talked about having our spouses on our payroll, she does a lot of work for me as well, also drives around the country as well. I think I'm going to buy her a Cadillac Escalade as well. So what did they do? In effect, they purchased 2 Cadillac Escalades that year and were able to write off $200,000 through the special depreciation. Again, being proactive, thinking ahead, and saying, if we were going to purchase a car, maybe we buy one of these heavy vehicles that's 6,000 pounds or more. So I'm not saying let's go out buy heavy vehicles because we could write them off through special depreciation allowance. I'm saying if we're going to be changing our car anyway, let's think about this. Joel, anything to add to this one?
Yeah, it's just such a simple thing. We're sitting here looking at wealth building. That's what this discussion is all about. So every time we save money in taxes, we're saving money in wealth. Somebody who comes to us who has taxable income at the end of the year, they were a sole proprietor, they owe $60,000, who buys that vehicle that Adrian's talking about. Somebody who took that vacation and now all of a sudden is deducting their airfare and their hotels and their car rentals. These things are thousands of dollars. I mean, and so every time you get to save them, the fun part is you still get what we call that upgrade of life, that lifestyle that Adrian talks about. And all of these things are part of our wealth building. We get a higher quality of living, and we also get to put away a few more dollars for all of us. And that's what we want. That's what we're here to do for you today.
Well, thank you so much. And as we talk about our last big tax strategy, definitely start shooting out any questions we might have in the text box. So Section 280A. This one, I'm always excited when I talk about this one, and I could tell you, unfortunately, not a lot of CPAs know about this. Like I mentioned earlier, I know Joel and myself, and I'm sure Wayne as well, we've actually spoken to other CPAs and taught them about this rule. So 280A is just the code of the IRS tax code. But before I dive into this, I want everyone to stop for a second and think. If you were to take a day per month to work on your business and not in your business, how much more effective would you be? Productive. How much better would your business be operating? So again, taking 1 day per month to work on and not in your business. Why would I say that? So here's what Section 280A is. You are able, as an individual, are allowed to rent out your primary residence for your home where you live. You're able to rent that out for 14 days or less per calendar year, and whatever income you collect, that is not taxable income to you. Again, this rule has been around for a while now. You're able to rent out your primary residence for 14 days or less, and your income you collect is not taxable income. Now, most of us don't want to Airbnb our house for 2 weeks. I agree. But what if that one day per month we're spending working on our business and not in our business, what we do instead of renting a meeting space at a hotel or at another venue, we're now renting our home? Or what if we decide to have a meeting with some of our clients and want to have seminars every month? And again, instead of renting out that meeting space, we're renting out our house. So our corporation is renting out our house for 14 days a year. What if it's $2,000 a day? What if it's $3,500 a day or $5,000 a day? So how do we come up with that dollar amount of what you is going to charge your corporation? We recommend getting 3 quotes from venues nearby in your area. Needs to be fair market value, either a hotel area or a meeting venue, and taking maybe the middle quote, and that's what your kind of appraisal will be, and your fair market value for what you is going to charge your business. So in our situation here, what if it's $5,000? So if you think about that, that's $70,000 we're able to shift over from our business to us tax-free. That's a lot of money. At the beginning, I talked about saving $10,000 per year. What if by this alone we're able to save $70,000 per year? Joel, I know that you also love talking about this, and we've worked on this a lot together. Anything to add?
You know what? Adrian's hitting on absolutely the most exciting thing of all. So here we are. We're having a meeting today, or you're having a meeting with your friends. You choose you're going to have a nice breakfast, a nice lunch, a nice dinner, some snacks, an open bar. And now just keep visualizing this because this is my wife. We have linens on the table. We have some flowers that she likes to do when we have company over, and we have some media equipment, our computers, our TV, etc. Whatever it is that we're going to have at this meeting, we go to that fair market place. If we have a beautiful home, something fair market to that. You can always look at an Airbnb comparison, but find out what this value is. Find that local hotel, country club, or restaurant, or a venue to have this meeting at. Find out what the cost would be. Using Adrian's example, not a surprise at all to me, of $5,000 a venue. For 14 of these meetings, all of a sudden we have $70,000. The truth of the matter is that $70,000 your business gets to deduct. They get to deduct 100% of everything I talked about except food and drink. That's 50%. And now you get to take that $70,000 and put it in your pocket. Let's talk about building real wealth. The tax savings on that $70,000 is just off the charts. And it's something that everybody should do. And I just want to end with, as Adrian said, I can't tell you how many times we talk about this in a seminar and how many CPAs come to us and say, can you teach us this? We just really want to make sure that we teach it to you, our Caldwell family.
Thank you so much, Joel. And this is not an easy one. And like I said, a lot of even CPAs don't know about this. You definitely need to have the right documentation. So please, definitely, as we're going to our last topic here, start filling out the chat box. Any questions after this, feel free to email us. Like Joel mentioned, any questions, we'll be happy to answer. Complimentary questions at manningsilverman.com. And those will come directly to me, actually. So I'll be following that email address. And finally, to wrap it up, we want to talk about run it like a business. Why? Because we have a business. Whether we end up incorporating, whether we end up not incorporating, as a sole proprietor, we are running a business. So let's have a separate bank account and a separate credit card. That's very much important, especially if we end up incorporating, because if we're mingling our personal bank activity and our business bank activity, what we're doing is piercing the corporate veil, and that's not good. If that happens, the IRS could totally throw out our incorporation and say whatever tax savings we have or had could be thrown out. Documentation, this is so important, especially on traveling, on Section 280A. Make sure we have proper documentation. Make sure we keep proper bookkeeping. Use some of these apps, Mile IQ to keep track of your miles, Expensify, QuickBooks, some best practices. Pay yourself a wage. Make sure you're paying quarterly taxes. I think Joel would agree, and if you want to add anything to this, it's so hard to give proper tax advice if some of our clients don't have proper bookkeeping.
I could just tell you my only addition I would say to everything that Adrian's talked about today is when you start to run it like a business, you will see things that start to happen that are beyond belief. From your children, people comment about my kids all the time. They're like, well, how'd your kids already start building wealth and they're in their 20s? It started very young. It starts when they're in high school or maybe even before in the case of my kids. It's things that you want to start teaching them. You want to teach them about wealth, savings, about your business, what you do. And what we really think is the more you share these things with your children, the more they learn, the more you build your wealth, they build their wealth with you. And at the end, what our whole goal is we really want all of you think about running it like a business. The success you will see will just be exponential. And that's the journey we want to be on with you.
Joel, thank you so much again. And finally, let's summarize what we talked about. Again, a lot of content. I hope everyone stayed with us. Definitely feel free to go back and watch this again once the recording is available. We talked about entity selection, the benefits of just incorporating as an S corporation, doing nothing more. We talked about commonly overlooked tax strategies, hiring our family members, having a formal business relationship with them, retirement plans, the benefit of that, the tax savings benefits, and also the wealth accumulation benefits. Travel, thinking of travel in a little bit different way than we're probably currently thinking of it. Depreciation, if we're going to buy a car, maybe the type of car we buy, we should look at that. Section 280A, this is an important one to know. Honestly, if you are taking notes, write down Section 280A, circle it 2 or 3 times, and don't forget to talk about that with your accountant or with us. And finally, run it like a business. We're all operating a business, we should run it like one. So in conclusion, we talked about that $200,000. How could that really change our lives? I know how that impacted my family directly, but how could that impact your family directly? Just by being smarter, being proactive, and not by working any harder. And with that, we want to open it. Chris, send it back to you, and we're ready for the Q&A whenever you are.
Excellent. That sounds great. Well, first of all, Adrian and Joel, thank you so much for so many excellent tax tips and strategies. You're talking about 70,000 here. You're talking about 200,000 there, $1 million over here. Pretty soon you're talking about real money, which is the whole idea behind this. And I got to admit, I've now gotten 2.5 pages of notes just from what you've said already. So this brings us to our favorite part of the program, the Q&A, where we get to hear from each one of you that are with us today. Now, remember, type your questions into the Q&A chat box on the right-hand side of the screen if you're on Teams. Message us if you're joining us today on Facebook Live. But let's get started. Amy, if you would be kind enough to send over the questions, that would be fantastic. And we'll bring back our illustrious team of Wayne, you're in the house. Welcome. It's great to have you with us. Okay, holy smokes, we have got a lot of questions here. Let's just start out. We'll just try and be as concise as we can on the answers. But listen, that's why we're here today. We want to make sure you get the information you're looking for. First question, Amy's teed up here, says, can you discuss a little bit about the home office deductions?
Wayne, you want to take the first one since we've been missing you for a little bit?
Sure, absolutely. Home office requires exclusive use of a specific area of your home to be used for business purposes, and all the expenses related to that specific business use can then be deducted as part of your tax return. So for example, if you have a home that you're using 20% of the total square footage exclusively for business, 20% of all of your expenses, the maintenance, the insurance, the upkeep, of course, the real estate taxes, the mortgage interest, etc., all get to be deducted. Now, I do caution that if you want to use the 280A, you can't use the 280A with the home office because then you're using the home for more than 14 days a year. So you have to make a choice which one of the two is going to be more advantageous for you, taking the home office expense or the 280A.
Great insight. Thank you very much.
I was going to say, I think what most of you will find is the Section 280 really does usually add up to more revenue than you can deduct for home office, except every so often in that first year of business, when you start to deduct all of your furniture or equipment that you have in your offices, sometimes that could make a change. Again, a great thing to talk with your tax advisor, or we'd be happy to do it with you anytime.
Yeah, that 280A sounds like a real gold mine. Hey, Joel, a question came in. Are you and your firm accepting do you accept out-of-state clients, and are you accepting any new ones?
So our firm is here in Lincolnshire. We have many offices across the country right now, but we are able to work with clients anywhere in the country, and in fact, anywhere in the world. We work with a lot of international clients as well as out-of-state clients.
Great. All right. Next question comes up here. It says, if you are now an LLC, is it very difficult to become an S-Corp?
Very, very, very simple. All you need to do is make an S election, and now all of a sudden you will be operating very similar to a S corporation. So very simple thing for us to do. It's just a two-form thing for us to make that change, or for you to make that change.
Great. Next question here looks like it's from LA. Fantastic. Is it too late in 2020 to establish an S Corp for the 2020 tax year, or not?
So not too late. Perfect time right now to actually make that election for a couple of reasons. One, to be able to start getting the benefit of between now and December 31st to start reducing some of that SE tax that Adrian talked about earlier. But in addition to it, there's a little strategy, and some of the strategy is, as an S Corp, this new entity, we can look at what expenses we can move from January 1st through today as maybe a management fee or other expenses to move into that S Corp to again save many thousands of dollars in that SE tax.
Okay, super. From Nashville, do I have to be an employee to qualify for an S Corp?
Adrian?
No, definitely not. For an S corp, once you're an independent contractor, what you're going to do is just strictly set up the S corp. It could be you alone. You don't need any employees. Once you're set up, you are going to be treated as both employer and employee. It's very, very simple. We explain it and have material that we could hand out. Be happy to do so. But it's very easy, very simple. You alone could operate your own S corp.
Okay, excellent. Can we pay our family even if we're not an S Corp?
Wayne?
The answer to that question is yes. If you're operating as a proprietorship, yes, you could still have family members on your payroll as a proprietor. One of the things that we do like about the corporate form of structure, in addition to the things that Adrian and Joel had mentioned, is that when you're paying these family members as payroll, and then you're including them as to why you're using them for travel, why you're using them for other business expenses, is being part of your corporate structure and part of your corporate board adds another layer of benefit if we had to detail this to the IRS.
Okay, that makes sense. Megan, thank you for your question. When you file an S Corp, do you get less Social Security when you retire?
Great question. The answer to that is possibly. So what Social Security is going to always look at, and we would share that discussion with you, they're looking at your top 10 years of earnings. So we do watch clients very closely as we start hitting the 50s to make sure where they're at. We, as a general rule, always put in part of our tax consulting part. We always ask people to get copies of where they're at with their Social Security. So we're looking at your 10 highest years. So our whole goal is, again, maximize your wealth. We want to make sure if maximizing Social Security is the best thing for you, we do that while we're still taking advantage of all the tax breaks. I always like to just answer it this way in my own personal situation. I want maximum Social Security for me. But one of the things I've learned since I've been working for over 50 years is, as I've been doing this, think about it, the top 10 years count for my Social Security. The other 40 years count for three things. They count to run Social Security, and I have to live with that. They help widows and orphans, and I appreciate doing that, and I'm happy to participate. And then they help support some of our governors here in Illinois who are in jail. So that's a part I hate spending my money on them. So it's a combination. Let's maximize our 10 years so that you maximize Social Security, and let's also maximize the tax deductions so we can help you build wealth.
That is a great plan. Okay, next question coming up from Bill. Are kids considered W-2 employees or 1099 independent contractors when you pay them, put them on payroll?
You want to take that, Wayne?
The most appropriate way to do that would be to put them on as formal payroll. It could be challenged more if you put them as a contractor. Are they actually a contractor? Are they providing these services to other entities, etc.? As a W-2 employee, almost never gets challenged. The only thing you do have to support is that they are doing some work. You can't pay them for doing nothing.
Got it. That makes sense. A lot of questions about family and kids and payroll. What about kids under 18 years old? Do kids have to meet a certain age requirement? How about paying a spouse?
Adrian?
Yeah, definitely. What we want to say is it definitely goes by state. What we know is that the child labor laws, we have to be very mindful of that. But if they work in a family office, so if it's your children working for you, I believe that in many states, and again, definitely check with your state, that's as young as 8 or 9 years old. Meaning 8 or 9 year old wants to go work at Walgreens, that's a no. If they're able to, help administratively or in the back office for parents, that's allowed. Same with the spouse. I mean, that would definitely work. Putting them on a W-2.
Excellent. All right. This question comes in from New Jersey. What documentation should I keep when traveling for business? This is maybe a two-part question then, and they're unrelated. Was net income calculated after all business expenses or before taxes? So those two questions.
Wayne?
First, I'll take the second part. Net income is always on the after effects. So you start with what your gross revenues are, you subtract out all your business allowable deductions, and then you come up with net income. So in all the examples we used, net is after business expenses. But the part of documentation is that if you're traveling, like Joel had mentioned earlier, just take pictures of your agenda. Take some pictures of the people you meet with. Keep some documentation, business cards of other associates around the country that you're meeting with, networking with, etc. That is all a great demonstration. If the IRS ever comes to look at it, we show it to them, that they accept it.
Excellent. Okay, next question comes up here. Is travel taxable only if you're incorporated?
Adrian?
Yeah, definitely. So travel, no, definitely. Even if you're not incorporated, if you're doing, legitimate business travel, you could still deduct that. Let's say you're not incorporating, but you're flying out of state, doing business work there. Definitely, it's a legitimate business deduction.
Okay,
The
excellent.
biggest concern going back, the
Yep.
biggest concern going back to the incorporating that Wayne mentioned earlier, you're really trying to think about a few things. You're trying to really think about when you set that entity up, reducing liability. As a sole proprietor, whatever money you make or whatever business operations you're doing, something should happen, God forbid, and someone sues you, and it can affect your business assets and your personal assets. When you incorporate, what you're really doing, setting up that entity, as Adrian said, is we're giving reason for the IRS not to be able to challenge anything. They're not able to challenge the board who's doing the travel. They're not able to challenge the W-2 employees, your children or your spouse when they're working for you. They're not able to challenge these things, which is the reason the structure is so important.
Excellent. Are there tax consequences to hiring a family member who may be over the age of 65?
Wayne?
The answer to that is yes. One of the things you'll be doing is continuing to pay in on Social Security taxes for that individual. So if they're over 65, you're adding to the Social Security. If they're actually getting higher earning years, depending how much you're paying them, they'll add to their Social Security benefits. If not, it's just additional tax you're paying in, as Joel had mentioned earlier. But once an individual is over age 65, it does not, or I should say full retirement age. Once they're at full retirement age, then their Social Security does not get reduced, no matter how much they continue to earn as W-2 earnings.
Excellent. Well, time flies. You're having fun, as you can see firsthand here. And who would have guessed taxes? So much fun. Certainly so informational. We have time probably for two more questions, and boy, there are a ton here. I'm going to try and pick two of them that are a little bit different. Quick answers, and we'll move right through these. First of all, vehicle. Other than the heavy vehicle special depreciation, what percentage of eligible expenses are given for vehicles?
You want to take that, Wayne?
That is Sure. You're allowed to deduct your business use percentage of all vehicle expenses. So, for example, if you're putting gas in the car, if you're insuring the car, if you're doing repairs and maintenance on the car, and you're using the vehicle for 85% for business, 85% of all those business costs are deductible.
Okay, so
Add in
more
their
on the
car
car.
washes, license plates. Sorry, I was going to say you
All
can
that
add in their
good.
car washes, license plates, tolls. We want you to get every deduction you're entitled to.
Cars are popping up everywhere, so let's do a couple here. First of all, do you have to pay cash for the vehicle? Number one. Number two, will we need to maintain a separate family vehicle to be able to write off the business vehicle? Should I lease or should I purchase? Take anyone you
So
want.
a real fun thing, yeah, a real fun thing is how fun is it? A client has $60,000 of taxable income at the end of the year. They go to buy a car, they put down $1, they sign the contract, they walk away with the car. They don't make their first payment until 30 days afterwards, and they get to deduct that vehicle. Using Adrian's 6,000 pounds, they get to deduct all 60,000 today. If you are a sole proprietor, just think about it. That's probably about $35,000 in taxes you save. So it's pretty fantastic what they allow you to do. You don't have to make the payment now. And I just want to say, generally, when you come to us or you go to your advisors, we want it to be a fun experience. We want it to go by like the time today did. And if there's any questions anybody needs, always feel free to reach out to Adrian, Wayne, or myself anytime. No charge. We'd love to meet you and hear from you.
Excellent. We have probably well over 100 more questions here. If you don't mind, I may send these on to you. And if you would be willing to answer a few of them, we'll post them on our wealthbuilderexpo.com site so people can then come back and get the information. This has been really helpful. Listen, a huge, big Coldwell Banker thank you to each one of you for your time today, your sage advice, your expertise on obviously a very hot topic. Thank you all, gentlemen. Appreciate it.
And
Hey,
I
listen,
would say,
before we
Chris,
wrap up-
we will
Yeah.
answer every question you have. So if you forward it to us, we'll answer all of them for everybody. We appreciate it.
Oh, thank you so much. We appreciate that. Have a great day. And again, stay safe. And thank you for joining us today. So listen, before we wrap up, I'd like to share a proven strategy as you embark on your personal journey of building wealth. Here's just an example. At Coldwell Banker Realty, we call it Rewards, and it's offered to actually all of our 48,000 agents. Now, Rewards was designed to provide you with a reoccurring secondary income stream. That's right, like think mailbox money, that income for years to come, just by doing what you do anyway. And that's telling your real estate friends and co-oping agents about our amazing company and how they can actually earn more money by affiliating with us and live an exceptional life. Well, I think this video actually says it best. You know, speaking of agent benefits, yes, valuable benefits for the independent contractor. Don't forget that the federal open enrollment period is happening right now. Now, this is a great time to review your healthcare choices, reassess the needs that you might have for yourself, working best for you and your family, everything for the upcoming year. Now, again, the opportunity ends on December the 15th. Coldwell Banker Realty proudly gives you two different opportunities for benefit choices. One is called Spark, and the other one is called MGA's Voluntary Insurance Plan VIP. Now, see the links on the screen. You can find them at the start of the chat, or just go to wealthbuilderexpo.com for all the details. There's so much good stuff there. Wow. I got to tell you, 2020 has been quite a year for all of us. That said, I would say that like that thin silver lining of the heartbreak, the frustration, and the confusion of COVID has actually given us the opportunity to bring you the Wealth Builder Expo series right to you, wherever you are, on the third Thursday of each month. Now, rest assured, We are committed to offering you real financial strategies and help you grow and protect your wealth, not just today, but into all of 2021 and beyond. And just think, this past year, holy cow, we brought you Chris Hogan on the topic of personal financial strategies. Dave Ramsey himself actually outlined the 4 essential strategies to building a stronger business. Craig O'Rourke shared strategies on how to buy your first or maybe even just your next income property. And we even heard from industry experts like Megan Tate and Stephen Weinrob on what it means to be a successful landlord. Then, of course, Mark Ferguson on how to navigate the fix and flip business. And today, discovering the tips and tricks to saving real money on your state and federal income taxes. Whoa, I gotta say, by any measure, we had a big year of discovery and learning in 2020. And if you found value in what we delivered in 2020, you're gonna love our lineup for 2021. Now, speaking of last month's topic, remember navigating the fix and flip business? I want to first of all thank you all for the great response and the feedback to the content. And to Mark Ferguson, our subject matter expert. And yes, I get it, folks. It was a lot of information. Quite frankly, it felt like we barely scratched the surface of such an important topic. We quickly discovered that it's just not possible to learn all the steps and nuances of the fix and flip business in just an hour. So we've got great news. We're going to be offering you an additional opportunity to join us for 3 additional sessions, all with Mark Ferguson. Now, each session is designed to help you dive deeply into the details and the next steps of the fix and flip business. Essentially, these are the steps you'll need to start your profitable fix and flip business. Or maybe you just want to become better educated. That way you can assist your clients and customers who may have interest in the topic themselves. Now, of course, like always, there is no cost for this Coldwell Banker Wealth Builder bonus program. The sessions will be held in January, February, and March. 1 session per month. They'll run about 90 minutes to an hour. We'll always have about 30 minutes of Q&A where you can get your questions answered. What a great way to kick off our year ahead. Now, the course will be limited to the first 500 registrations. So not today, but starting on Monday, we'll be opening up registration at WealthBuilderExpo.com. So be sure you don't miss that opportunity. Now, I think you probably know this, but today's session just wouldn't be complete without a word from our partners and our really good friends at Guaranteed Rate Affinity. Yes, a big Coldwell Banker thank you to Guaranteed Rate for making our Wealth Builder series possible. Check out this great video.
You know how to help your clients find the home of their dreams, and we know the perfect mortgage can make that dream come true. We are Guaranteed Rate Affinity, a joint partnership between the 3rd largest retail mortgage lender and your company. We're here to help you look good to your clients and sell more homes. How? First, we make the process as simple, seamless, and awesome as possible. And that starts with our expert loan officers. You might have met some of them as they work alongside Coldwell Banker agents. Clients love our easy digital mortgage, which can have them ready to make an offer in minutes. We have over 100 loan products with some of the fastest turn times in the industry. And because our loan experts are fueled by the most advanced mortgage technology platform, we can help you and your clients at any time, from anywhere. Plus, you'll love tools like Loan Status Monitor that keeps you in the know, and Flash Close that shortens closings from hours to minutes. Above all, we're committed to the belief that your success is our success. So, when a buyer needs a mortgage referral, bring it home to the loan officers who work right alongside you to get dream homes closed. We are Guaranteed Rate Affinity, and we are your mortgage company.
There is no question we are lucky to be partners with Guaranteed Rate Affinity. Well, folks, that's a wrap for today's session and a wrap for our 2020 Wealth Builder series. I'd like to thank our entire Wealth Builder team who made our 2020 season possible. Amy Crawford, Stephen Dangerfield, Chris Clark, Mike Fisher, Kelly Griffith, Morgan Nordquist, Melissa Santone, and the magic behind the technology himself, Joe German. Listen, it's an unbelievable team, and I thank all of you. Now, as a reminder, a recording of this program and many of our prior sessions can be found at WealthBuilderExpo.com. We look so forward to seeing you in the new year, but until then, I'm Chris McGatt, encouraging you to stay focused, stay disciplined, and committed to ensure your best financial years are just around the corner. Happy and a safe Thanksgiving to you and your families.